Hello, my CFA friends. How are you, my friends? In this reading, we are going to start pricing forwards. So we're going to talk about our basic cost of carry model. We're going to introduce the costs of carry, the benefits of carry. We're going to include them in the expanded cost of carry model. So a pretty fundamental reading, if you ask me. So let's get started. First, we need to talk about arbitrage. Now, I like to think of arbitrage as having a free lunch. So we're going to be capturing some sort of riskless profit. Okay, typically it's going to involve us entering into an offsetting transaction, buying and selling at the same time, and that offsetting transaction will eliminate the risk but allow us to capture some positive profit. So this is all based initially on the concept of the law of one price. Okay, and the law of one price states that identical assets must trade at the same price. Okay, that's pretty logical. If I've got a couple of apples, exactly the same apples, commoditized product, they should really be trading at the same price. They're identical assets. But arbitrage will arise when that law of one price is violated. For example, I could be buying the apple cheaper in one market and selling it more expensively in another market. Okay, so obviously here we are going to adhere to our basic financial mantra. If we found that the identical assets are mispriced, they're trading at different prices, perhaps in different markets, then we're going to buy low the underpriced asset in the market where it's trading cheap, and then turn around and sell it high in the market where we observe that the asset is overpriced. So please keep adhering to your basic financial mantra, buy low, sell high, and you should be doing quite well in finance. Now, the reason why this is arbitrage here is because we are doing it based on an identical asset. So we're eliminating the risk and we're capturing riskless profit. Now I need to introduce the basic cost of carry model, which is, as you can see here, expressed with discrete compounding or continuous compounding. I'm going to cover both, but this cost of carry model will allow me to calculate the arbitrage-free forward price, and that's going to be based, as you can see here, on the spot price today, the risk-free rate, and the time to maturity. Now, you might be wondering why is the risk-free rate in this formula? What does it have to do with the pricing? Well, we have to think of the risk-free rate as the opportunity cost of carrying the asset. And what I mean by that is, if you actually wanted to own physically an asset, you would either have to borrow mana in order to buy the asset, or you would have to withdraw some money from your savings account or investment account, and effectively there will be an opportunity cost associated with doing so. So if we wanted to price correctly the forward, which is effectively a price I'm gonna have to pay in the future, well, then we need to incorporate the cost of carry, i.e. the risk-free rate, which is our opportunity cost here, within the spot price carried to maturity. And so we get our two basic models. This is the discrete model. So the forward price agreed today for delivery at time t in the future is given by the spot price compounded at the risk-free rate to the power of time to maturity. Or if we're using continuous compounding, say hello to our good old friend, Mr. Euler. Hello, Mr. Euler, 2.7. So we're just taking the spot times e to the power of risk-free rate times time. And that's pretty much achieving the same thing, but with continuous compounding. Now, any price, any forward price that deviates from these theoretical equations will allow us to exploit arbitrage, which we defined on the previous page. So therefore, the market price of the forward must agree with the theoretical price given by these equations. And if it doesn't, then a clever arbitrageur, a clever arbor, can step in and exploit the mispricing. And that's what we are going to actually illustrate on the next slide. Okay, let's first calculate the 1-year arbitrage price, assuming that the spot price is 100 and the risk-free rate is 10%. Once we've determined that, we will then see if there is an arbitrage trade given a forward price of either A, 112, or B, 107. Okay, well, first of all, let's use our basic cost of carry model, which states that we have to take the spot price today, which is 100, compound it at the 1 plus the risk-free rate, which is our opportunity cost, to the power of time to maturity, which in this case is 1 year. And so here we are getting a theoretical forward price of 110. Now let's look at scenario A. In scenario A, the forward price is actually 112, and that is greater than the theoretical price of 110. So one could therefore conclude that the market price of the forward is too high. In other words, the forward price is overpriced. So now I need you to think about the steps that you're going to take to exploit this mispricing. Pause the video, think about it, and when you're ready, let's jump into Word and write it all up. Okay, my friends, scenario A, forward price of 112 is higher than the theoretical price given by our cost of carry model of 110. So the steps involved in exploiting the arbitrage opportunity are as follows. Okay, well, the forward price is too high, so we're going to short the forward at 112. And what that means is we're promising to deliver the asset in 1 year at $112. Okay, so think about it. I've just made a promise to deliver the asset in the future. What do I need to do today? Well, I better make sure that I need to own the asset today. Okay, but I'm an arbitrageur. I'm a knob. I don't have any money. So what I'm going to do instead is I'm going to borrow $100 at 10%. And now I'm going to have $100. And so I'm going to be able to buy the asset. Okay, so I've promised today to sell the asset in the future at 112. And simultaneously today, I've borrowed $100 at 10% and I've bought the asset. Now, the next thing I need to do is carry the asset to maturity. What I mean by carry is store the asset if it's a commodity, or just keep the asset if it's a financial asset, but carry it to maturity and deliver it at 112. Okay, because we've already pre-agreed to deliver it at 112. But we also will have to have another step here, which is repay our loan of $110. Okay, I borrowed 110, so I'm going to owe $110 and keep an arbitrage profit of the difference, 112 minus 110, which is going to be a couple of dollars. Now, it is strategy here where the forward is above the theoretical price. This strategy, my friends, is known as a cash and carry arbitrage strategy. Okay, my friends, let's turn our attention to strategy Bravo. In scenario Bravo, forward price of 107, that's given as our market price, is lower than the theoretical price of 110. So this time the forward is underpriced because it is trading below its theoretical price suggested by the cost of carry model. The steps involved in exploiting the arbitrage opportunity are as follows. So here I've simply copied what I wrote for the previous example because I want you to see how easy it is to reverse everything and to basically exploit the strategy in reverse order. So now, because the forward price is too low, I'm going to want to exploit that by buying the forward, by longing the forward, by promising to buy the asset at a future date. So the word here, of course, will be long the forward at 107. Now, remember what that means? That simply means that I'm promising to buy that asset in a year's time at $107. Okay, so what I'm going to do today then, always remember, you want to offset. If you're going to be buying something in the future, you want to be selling it today. So what we're going to do here is we are going to short sell the asset today at $100. Now, what short selling means is that you're going to borrow the asset from somebody, and then you're going to sell it, and you're going to end up with $100 in your account. And of course, you're not going to stick that under your mattress, are you, my friends? You're going to take the $100 and invest it at 10% so that it can earn you some interest, so that in 1 year's time, you're going to have $110, right? Okay. Well, there is no need to carry the asset to maturity, of course. So that step is not going to be there, okay? But instead, what I need to do is at maturity, buy the asset for $107. But remember, your account is now worth $110 because remember, you invested $100 at 10%, so your account is now worth $110, but you're only buying that asset for $107 in order to cover your short position. Okay? So therefore now we could say that after covering your short position, you get to keep an arbitrage profit of the delta 110 minus 107, which is a nice riskless arbitrage profit of $3. Now, we basically reversed what we did in the cash and carry strategy, so take a wild guess here what the name of this strategy might be. And if you guessed that it is known as a reverse cash and carry arbitrage strategy, my friends, give yourself a massive pat on the shoulder, and let's move on. Next, we are ready to incorporate additional costs and benefits of carry into our cost of carry model. So let's just go over all of them. We've already worked with the risk-free rate, which we know is an opportunity cost. Once again, if you want to own the physical asset, you either have to borrow the money or you have to withdraw the money from some sort of savings or investments account. So the risk-free rate is acting as the opportunity cost of physical ownership. Secondly, if you are going to be owning physically a commodity, especially, you're going to probably have storage costs, right? Wheat is very expensive to store in silos, natural gas, oil, etc. You're going to need to store the commodity. You may have to insure the commodity. And also, if it's a commodity such as wheat or livestock, of course, there will also be spoilage, and there's additional costs of physical ownership that need to be considered within the formula. However, on the flip side, we've got some good news. When you own an asset, you're also going to benefit from that. So if it's a financial asset, you will benefit from that in terms of dividends. So payments on your stocks or coupons, payments or your bonds. Or there is a funky benefit of carry known as convenience yield, which is enjoyed by manufacturers. So let's jump into Word now and let's properly define convenience yield. So, my friends, convenience yield is the non-monetary benefit of owning a commodity as a raw material. Okay, very, very important. So if I'm a manufacturer, for example, I manufacture cars, and for my cars, I need copper, I need aluminum, I need batteries, I need chips, and so on. I am going to want to actually own these commodities in my warehouse in order to keep building the products, okay? And that desire, that need to own the commodity physically is going to be defined as a convenience yield, and convenience yield is going to be treated as a benefit of carry. So convenience yield is particularly high during times of supply shortages. Okay, so let's just try to intuit this. If I've got a supply shortage, for example, there is a supply chain disruption, for example, products are not coming from China for any reason, well, then manufacturers are going to be very worried about that, and manufacturers are going to want to hoard the commodity in physical stock in order to make sure that they have enough of it when a need arises. Support my channel and sign up to the question-based revision for an unbeatably low monthly price. Just go to stoinov.co.uk/revision. There are no contracts and you can cancel anytime. The link is in the description. And while you're here, smash the like button. But let's start incorporating costs and benefits of carry into our cost of carry model. We've seen a basic cost of carry model that simply says spot compounded at the risk rate to maturity. Now we could create what I call an expanded cost of carry model, where we introduce costs of carry such as storage and benefits of carry such as dividends, coupons, and of course convenience yield. Now, you can see I'm giving you two formulae here. This is the sort of discrete formula, let's say with annual compounding, and this down here is essentially the same formula using continuous compounding assumptions. Okay, so I think you just need to focus on one of them, to be honest, and I would probably be focusing on the top one, conceptually for level 1. Not likely to be seeing massive computations in this area, but for level 2, yes, you will be pricing and valuing forward, so start getting ready for that. So if I just look here what I'm calculating again the arbitrage-free forward price, the price at which arbitrage is prevented. Arbitrage cannot take place. So it's the forward agreed today for maturity at time t. I'm going to take the spot price today, and here's the key thing. I'm going to be adding the costs of carry and subtracting the benefits of carry. Oh, hold your horses here. Hold your horses. Let's try to explain this. Why am I adding the costs and why am I subtracting the benefits? Very, very important. Well, you gotta think of it in terms of compensation, right? So there's gonna be someone who wants to long the forward, but also there's got to be someone who is going to own the physical commodity, who's willing to keep that commodity for 1 year so he can deliver it to you in 1 year's time via the forward. So that physical owner is incurring costs, all right. So he's incurring storage costs, he's incurring insurance, spoilage, and so on. He needs to get compensated for that, my friends, okay? He needs to get paid for the fact that he's storing the commodity. So those costs will be passed on to the person who is purchasing the commodity in the future via the forward. So we're taking the spot today, okay? You're paying for the commodity, of course, but you're also paying for the costs of whoever is going to store that commodity for 1 year on your behalf. On the flip side, however, the physical owner is enjoying the benefits that come with physical ownership. What are the benefits? Well, if it's a financial asset like a stock, you got dividends, happy days. If it's a bond, you got coupons, great, that's mana coming in. And if it is a raw material like copper or aluminum, you might be getting some convenience here there. And again, that is a benefit, so you're going to want to subtract it. So if you want, you can think of the costs minus the benefits as being the net cost of carry. Okay, net in the sense that we are netting the benefits against the costs. And notice here that we have to take the present value of these costs and benefits. So if they're given as future values, we first present value them to time 0, the same point on the timeline as spotted time 0. Then once we've got all that in the square brackets, we proceed in the usual manner, which is to compound at the risk-free rate to maturity. Now, when you're looking at the second formula, you might be thinking, hey, Martin, this looks very different, but really it doesn't. You're just taking the spot, you're compounding it at Mr. Euler continuously, and what are my costs of carry? Well, here they are, they're being added, the benefits are being subtracted, and of course, the risk-free rate is also being added because it's acting as an opportunity cost. So we get to a very, very important conclusion here. What is the relationship of the forward price with respect to the spot price? Well, if the costs of carry exceed the benefits, so if you've got a lot of storage costs, if risk-free rates are very, very high, but the dividends, the coupons, the convenience yield is not as high, then we looking back at the formula, we are going to have a lot, of course, being added to the spot price, but not a lot of benefits being subtracted. So that's going to give us a forward price that is above the spot price. And at level 2, I'm going to have to teach you the lingo. When the forward price is above the spot, when your futures curve is upward sloping, that is known as contango, my friends, contango. Now, you don't need to know this word just yet for the level 1 syllabus in this reading, but FYI, forward price or futures price above the spot price, that's going to be contango. Now, of course, if I've got benefits that exceeds the cost, so let's say the commodity is in super short supply, convenience yield is through the roof, but the costs of storage are, let's say, not very high. So in this case, benefits exceed the cost. Well, we're subtracting a lot more from the spot price than we are adding. So now the forward price drops below the spot price. We've got a downward sloping futures curve. And that, my friends, is known as backwardation. So we've gone through all the theoreticals. Now let's go through some numericals. We're going to calculate the arbitrage profit here on a forward contract given a spot price of $15, forward price, which is the market forward price of $15.50, maturity of 3 months, and a risk-free rate of $7. So you can see here we've got the basic cost of carry model. Nice little warm-up challenge here. So we are going to take the spot price. The spot price is 15. We are going to compound at 1 plus the risk-free rate. We're going to raise this to the power of 3 months. Now, 3 months, it has to be expressed as a fraction of a year. So if you know that 3 months over 12 months is spot 25, you can go directly here, spot 25. So 3 over 12 is a quarter. And that's going to provide us with our answer. Okay, so our answer is $15.26, and arbitrage profit will be given by the delta market price of the forward, which we know is $15.50. So $15.50 is the actual market price of the forward, but the theoretical price should have been $15.26. Well, there is a delta here of spot 24. So the arbitrage profit here is 24 cents. Now, we could also say that because the forward price is above the theoretical, we should be exploiting this. Pause the video and think about it. What's the name of the strategy? When the forward is overpriced, we should be using a cash and carry arbitrage strategy, my friends, which means we are going to be shorting the forward at $15.50, but we're going to be borrowing today $15 at 7% for 3 months and purchasing that asset and then carrying it for 3 months and delivering it at the overpriced forward agreement at $15.50, repaying the loan, and thereby keeping an arbitrage profit, a riskless profit of 24 cents. Next, we're going to complicate things a little bit. We're going to introduce some dividends, some benefits of carry. So again, calculate the arbitrage-free forward price given the spot. Now, this time we've got a dividend of 40 cents coming to us in 3 months, and then another dividend slightly higher coming to us in 6 months. The risk-free rate is 7% again, and the maturity of the contract is 6 months. Now, my friends, always, when you're doing derivatives problems like that, please use a timeline, okay? Always use a timeline, my friends. So what you're going to do is you're going to put yourself at time 0 and write a lovely little stick main, and that's going to show you where you are on the timeline. So you're at time 0. Then you've got time 3, and at time 3, you're going to get a dividend of 40 cents, and then there is time 6. You're going to get a dividend of 50 cents, and then obviously the contract will also mature at that point. Now, our first job is, remember, we need to have the present value of the benefits. So this needs to be discounted back 3 times or 3 months, and this needs to be discounted 6 months, and then the sum of that would represent our present value of the dividend. Then we're going to take the spot price, which is $10. So we're going to take S0 minus the present value of the dividend. That will then have to be compounded forward 6 months in order to compute our forward price. So that's basically our plan. That's our strategy. If we can now implement that mathematically, we're going to be able to obtain the correct answer. Okay, then let's have a look at the PVD. So the present value of the dividend will be the sum of the present value of both dividends. So our first dividend is 40 cents arriving to us in 3 months' time. So there's the 40 cents. There's the risk-free rate down here, and that is raised to the power of spot 25, which, remember, is 3 over 12, right? So 3 months as a fraction of a year, spot 25. Then I'm adding the second dividend, which is 50 cents. That's arriving to me in 6 months. That's half a year, spot 5. And the sum of the present value of these 2 dividends is spot 87.67, rounded to 4 decimal places. Now, always do a sanity check. 40 plus 50 is 90. Then you obviously have to discount that back. And 90 cents is the undiscounted cash flow. So if you discount it back, you're getting shy of 90 cents, which is 87. Fantastic. That seems to be working. Then I need to take my spot price, which is $10, knock off the present value of the dividend, Okay, so spot minus PVD, which then you can think of that as the net spot, so the spot net of the dividends, which we can then compound at 7% for 6 months, so raised to the power of 0.5, and that hopefully should give us the correct answer of $9.44. Next, we're going to apply pretty much the same idea, but we're going to just try to do it with continuous compounding. So my spot price is $150, risk-free rate 7, dividend yield 3. So cost of carry here exceed the benefit of carry. Maturity of the contract is going to be 9 months. I'm expecting the forward price to be above the spot price. I'm expecting to be in contango. Okay, let's get started. So my forward price will take my spot price of 150. Now remember, I want to be using continuous compounding. So let's go our friend Mr. Euler. Mr. Euler, how are you? E to the power of 7 minus 3. So always put the costs first and then subtract the benefits, and then also multiply by the time factor, which in this case will be 9/12 or spot 75. And just to show you how this is done on the calculator, remember, with this calculator, you kind of gonna be doing the reverse of what you would do on your good old Casios. So instead of starting with the 150, which you would normally be tempted to do, you're gonna start with the power. So do whatever is easy in your head. So 7 minus 3 is pretty easy. I'm not gonna be typing that into the calculator. I know that's 4%. So take 4%, then multiplied by your time factor. Okay, hit equals, that is your power that you need to raise magic number e to. So you can see here you've got e to the little x above the natural logarithm. So how do we access labels above the buttons? Of course, we use second button, so second ln. Therefore, now gives us e to the power of that power here. And finally, we have to multiply by 150, and that's going to give us our answer here, which is $154.57. And my friends, we are going to be finishing this reading by talking about obtaining the forward exchange rate via the arbitrage-free relationship for FX. And spoiler alert, this has already been covered in economics. I hope you've watched those videos, but if not, do check them out. So we are going to be using our covered interest rate parity. However, in this case, we're going to be using continuous compounding. Now, remember that in economics, we use this idea where we said the forward price is the spot, and then we multiplied by 1 plus RP over 1 plus RB. So that's discrete compounding. And the same idea with continuous compounding looks as follows. We're taking the spot exchange rate, then we're using E to the power. First goes the price interest rate, second goes the base interest rate. So what I don't want you to be thinking here, don't think domestic and foreign. That is a recipe for disaster, because what may be your domestic currency may not be my domestic currency. Your domestic currency could be the dollar, because you're in America, but I'm in the UK, so my domestic currency in the pound. So whilst it is possible to answer them like that, I wouldn't worry about domestic versus foreign. I would simply use an objective definition, such as the numerator and the denominator. So if I have dollars over pounds, that is my numerator. And so that is my price currency in the quote. And the denominator, the base currency, the 1 unit, is, of course, my base currency. So if the exchange rate is given as dollars per 1 pound, then I need to consider the RP being the interest rate for dollars and RB being the interest rate for pounds. Next, we're going to jump in to a numerical example, and we shall do all that with continuous compounding. Okay, when I've got problems that involve currency pairs, the first thing I always do is look at the pair. So that's USD divided GBP. So it's dollars per £1. So it's $1.30 per £1. So think about which one is your price currency, which one is your base. If you said the dollar is your price and the pound is your base, please high five me. That is the correct arrangement. So numerator is your price, denominator is your base. That is your spot price. So now you know that this is the interest rate for the price currency. This is the interest rate for the base currency. And in the discrete formula, if I go back here, the interest rate for the price currency goes in the numerator and the interest rate for the base currency goes in the denominator. But here we need to do it with continuous compounding. So just remember that the numerator interest rate simply goes first and the denominator interest rate goes second. So that's pretty easy. The numerator is on top. So what you're going to do, you're going to put it first in the continuous formula. So if I just say the forward price here is the spot price, Mr. Euler, then the first interest rate I need is 3%, the second one is 2%, and then I'm going to need a time factor of 15 months, which is 15 over 12, or 1.25. And again, let's just make sure you can do this on your calculator. 3 minus 2 is 1. We start with the power, multiply by the time factor, hit equals, and now we want e to that number, so second ln, and then multiply by the spot as our final step to give us the arbitrage-free forward price of $1, spot 31.64. My friends, that's all I wanted to cover in this reading. I hope you found it useful. And I'm gonna be so excited to meet you in the next derivatives reading. Until then, have a great day.